journey in your last two. I sweet med tea when they turned in. The styron down to mute. And can land a pole that sunk he died.
This slide introduces a very common situation for owner-managers. The shareholder owns a vehicle personally, but regularly uses that vehicle for corporate business activities. This arrangement is extremely common in small and medium-sized businesses because it allows the shareholder to maintain personal ownership of the vehicle while still using it to support business operations. Let's start with the ownership side of the picture. The vehicle is personally owned. The registration is in the shareholder's name. The insurance is personal, and the shareholder is ultimately responsible for the vehicle itself. From a legal and tax perspective, the vehicle is a personal asset, not a corporate asset. However, even though the vehicle is owned personally, it may still be used extensively for business purposes. The shareholder may drive to visit clients. They may attend business meetings. They may travel to customer locations. They may deliver products or documents. Or they may travel between business sites. In other words, the vehicle is helping the corporation generate income and carry out its business activities. This creates an important issue. Business use of the vehicle creates costs for the shareholder. Every business kilometer driven consumes fuel. The vehicle experiences wear and tear. Maintenance costs increase. Repairs become necessary. Insurance costs may be affected. And over time, the value of the vehicle declines because of additional usage. These costs are real economic costs that the shareholder personally bears. If the corporation benefits from the use of the vehicle, it is generally reasonable for the corporation to compensate the shareholder for that business use. This is the central concept illustrated on this slide. A personally owned vehicle is being used to support corporate activities. Because the corporation receives the benefit of that use, some form of compensation may be appropriate. The goal is not to provide a shareholder benefit. The goal is to reimburse or compensate the shareholder for legitimate business use of a personal asset. This distinction is important because it helps ensure that the shareholder is treated fairly, while also allowing the corporation to recognize a business-related expense. In practice, the challenge becomes determining how that compensation should be calculated and paid. As we will see in the next slides, there are generally two common approaches. The corporation can pay a mileage allowance based on business kilometers driven, or it can reimburse actual vehicle-related expenses. Each method has its own advantages and administrative requirements. The key takeaway from this slide is simple. A personally owned vehicle often plays an important role in business operations. When the shareholder uses that vehicle for corporate purposes, real costs are incurred. As a result, compensating the shareholder for legitimate business use of the vehicle is often appropriate and forms an important part of owner-manager tax planning. Now that we've established that a shareholder may be entitled to compensation for business use of a personally owned vehicle, the next question is, how should that compensation be paid? In practice, there are two common approaches. The first method is a CRA mileage allowance. The second method is reimbursement of actual vehicle expenses. Let's begin with the mileage allowance approach. Under this method, the shareholder tracks the number of kilometers driven for business purposes throughout the year. Accurate mileage records are essential because the amount of compensation is based directly on the business kilometers traveled. Once the business kilometers have been determined, the corporation pays the shareholder an allowance using the CRA-approved mileage rate. The more business kilometers driven, the larger the allowable reimbursement. This approach is straightforward because the corporation does not need to calculate individual fuel costs, repair expenses, insurance amounts, or other operating costs. Instead, the CRA mileage rate is intended to reflect the average cost of operating a vehicle for business purposes. The shareholder receives compensation, and the corporation records the payment as a business expense. The second method is expense reimbursement. Under this approach, the shareholder collects receipts and supporting documents relating to vehicle expenses. These expenses may include fuel, maintenance, repairs, insurance, licensing costs, and other vehicle-related expenditures. The corporation then reimburses the shareholder for the portion of those expenses that relates to business use. This method requires considerably more record-keeping because each expense must be documented, and the business use portion must often be calculated. For example, if a vehicle is used partly for business and partly for personal purposes, only the business-related portion is generally eligible for reimbursement. As a result, detailed records become extremely important. Both methods are attempting to achieve the same goal. The shareholder is using a personal vehicle to support corporate activities. The corporation wants to compensate the shareholder fairly for that business use. The difference lies in how the compensation is calculated. One method focuses on business kilometers. The other focuses on actual vehicle expenses. The process shown at the bottom of the slide summarizes the overall approach. First, the vehicle is used for business purposes. Next, records are maintained. Those records may be mileage logs or expense documentation. Then a compensation method is selected. Finally, the corporation compensates the shareholder for the business use of the vehicle. At this stage, neither method is automatically right or wrong. Both approaches can work when implemented properly. The important requirement is that accurate records be maintained and that the compensation reasonably reflects the business use of the vehicle. The key takeaway from this slide is that corporations generally have two common options when compensating shareholders for business use of a personal vehicle. They can use a mileage allowance based on business kilometers, or they can reimburse actual vehicle expenses. Both methods seek to compensate the shareholder for legitimate business use while ensuring that appropriate records support the amounts being paid. Now let's look at why many accountants and tax advisors prefer the CRA mileage allowance method when compensating a shareholder for business use of a personally owned vehicle. As we discussed in the previous slide, there are two common approaches. A corporation can reimburse actual vehicle expenses, or it can pay a mileage allowance based on business kilometers driven. While both methods can be valid when implemented properly, the mileage allowance approach is often viewed as the simpler and more practical solution. Let's begin with the advantages of the mileage allowance method. First, it is relatively simple to administer. The shareholder tracks business kilometers throughout the year using a mileage log. Once the total business kilometers are determined, the corporation applies the CRA-approved mileage rate and calculates the allowance. The process is straightforward and easy to understand. Second, the mileage allowance method is widely recognized and accepted by the CRA when reasonable records are maintained, because the allowance is based on CRA-established rates. The administrative burden is often lower than under a detailed reimbursement system. Third, record keeping is generally simpler. Instead of maintaining and allocating every fuel receipt, repair invoice, insurance payment, and maintenance expense, the shareholder primarily focuses on maintaining accurate mileage records. The key requirement is demonstrating how many kilometers were driven for business purposes. Another advantage is that compensation is directly tied to business use. The allowance is based on business kilometers rather than total vehicle expenses. As a result, the corporation compensates the shareholder specifically for the business use of the vehicle. This creates a straightforward relationship between the business activity and the compensation being paid. Now compare that to the expense reimbursement method shown on the right side of the slide. This approach typically involves much more documentation. Fuel receipts must be retained. Maintenance records must be organized. Insurance expenses must be tracked. Repairs must be documented. And in many cases, costs must be allocated between personal use and business use. That allocation process can become time-consuming and administratively complex. The corporation and the shareholder must be able to support how each reimbursement amount was calculated. That does not mean the reimbursement method is wrong. In some situations, it may be entirely appropriate. However, it generally requires more effort, more records, and more detailed calculations. The process in the center of the slide illustrates why many advisors prefer the mileage approach. Track business kilometers. Apply the CRA mileage rate. The corporation pays the allowance, and the shareholder is compensated. The system is relatively easy to understand and administer. Of course, one requirement applies regardless of which method is chosen. Accurate records are essential. A mileage allowance only works when business kilometers are properly documented. Likewise, expense reimbursements require detailed supporting documentation. Good records remain the foundation of either approach. The key takeaway from this slide is that a reasonable CRA mileage allowance is often the simplest and most tax-efficient method for compensating a shareholder for business use of a personally owned vehicle. It reduces administrative complexity, aligns compensation with business activity, and provides a practical solution that is widely used in owner-manager tax planning.